Thank you, Fred, for that warm introduction, and thanks to all of you for coming. I'm sure the main reason is the wonderful lunch we put on, but I appreciate your showing up. The reason why I wrote this book was really driven by research I was doing over, as Fred said, the past 25 years. In particular, over this period, we saw a world being more globalized, countries being more closely linked by trade and investment flows, and we saw inflation rates being brought down after the high inflation of the 70s and 80s and harmonized around the world. And yet, despite all these developments, exchange rates remained highly volatile. And so I want to know, what is driving these movements in exchange rates? What features of the economy make it possible for such large movements to occur? What is the cost to the economy of this volatility, and what should policymakers do in response? That's what the book tries to do. The focus is on mainly on the advanced economies and some of the leading emerging markets, but there is a chapter on developing economies more broadly. I cover both large and small economies, and even including some very open economies, because I want to counter the view that there's a commonly held view that, well, flexible exchange rates are fine enough for a large, relatively closed economy like the United States, but they really aren't appropriate for small, open economies. Well, I just don't think that's true. I love to bring up the case of New Zealand, which is a small, open economy that I think has done quite well with flexible exchange rates. It's important to recognize that when I talk about volatility today and in the book, I'm talking about long-run swings in the exchange rate. So, for example, here is a chart of the value of the euro in the first 6 years of its existence, and what you see, the dotted line is the daily value of the euro in terms of the dollar, and then the solid lines are the average of those daily values in each quarter over this period. Now, short-run volatility is really the ups and downs of the dotted line against the solid line. That's not the focus of the book, and that's not the kind of volatility I'm going to be focused on. I'm focused more on the big swings in the exchange rate. In the first 2 years of its existence, the euro depreciated 25% against the dollar, stayed there for a couple of years, and then it appreciated about 45% in the last 3 years. So those large swings that are long-lasting are sort of the focus of the book. How is it that they can exist? To avoid leaving you in continued suspense, the key findings of the book are that floating exchange rates, in fact, do appear to be excessively volatile in a way that I'll mention. But the volatility, the harm from this volatility is less than the harm of moving to fixed exchange rates in most cases. And in particular, people have looked at the effect that this volatility has on long-run growth or income, and it's hard to find any evidence either way. We'll discuss that. But when countries combine a floating exchange rate with sound monetary policy, then it's quite clear the evidence is quite strong. The evidence is quite strong that there are benefits to be had in stability of inflation and output and employment. Now, I'm going to talk casually often of fixed versus floating exchange rates. But of course, in reality, there's a spectrum of exchange rates ranging on the left from a currency union, which is just a completely fixed exchange rate in which you actually throw away your currency and join in with your neighbors in a common currency, most notably in the euro area. Then there's hard peg exchange rate where there's some institutional enshrinement of the value of the exchange rate. Then there's the standard adjustable peg, which is a commitment to maintain an exchange rate, but it's not enshrined into law or institutions. Going to the far right, we have a free float, where the central bank actually doesn't have any particular concern about the exchange rate at all. The important divide for my book is between the soft peg category, which includes things like crawling pegs and wide bands, and the managed float category, which I define as a regime in which a managed float is a regime in which a central bank responds to the exchange rate, but it doesn't have any particular value that it will defend, which sort of is a line in the sand. So that's sort of a key distinction. I'm going to use the words peg and fix as synonyms and floating and flexible as synonyms throughout. Okay. So the theory of exchange rates, when markets are open, both to trade and to investment, so capital can flow freely as well as goods, is that exchange rates should enforce two arbitrage conditions that are central to our analysis. One is called purchasing power parity. That is that exchange rates should equate the average prices of goods across countries, and so if one country is more expensive than another country, then it should be importing more. There should be trade flows associated with that inequality that should set up forces to re-equilibrate prices. And so it's important to keep in mind this is an important effect of exchange rates, is that they do influence demand and supply to a country. So if you have a cheaper currency, then you will tend to have growing exports, and vice versa if you have an expensive currency. So this is sort of one of the channels that exchange rates can affect the economy. These forces should bring prices back into line over time. The other condition is interest rate parity, which sort of is the finance analog of purchasing power parity. This says that investors should basically see similar rates of return across countries, in particular on interest rates on deposits and on bonds in different currencies should be equalized, or the return, once you take into account exchange rate movements, should be equalized. Okay, so now with a fixed exchange rate, then the fixed exchange rate, purchasing power parity has to work through inflation rates in different countries, and interest rate parity has to work through interest rates being equalized. But with a floating exchange rate, then prices can be different in different countries as long as the exchange rate moves to offset that, and same for interest rates. What this says is that in particular under a floating exchange rate regime, you would expect that the volatility of exchange rates should be linked to the volatility of relative prices across countries and interest rates across countries, so that there should be some connection between these three things. And in fact, in the 1980s and the 1990s, a period of volatile exchange rates, most economists thought, and the book cites three, which I mention here, thought that if countries stabilized prices and inflation was low and stable around the world at a similar rate, that would stabilize exchange rates. You would see a big reduction in the volatility of exchange rates. Well, in fact, that didn't happen, and that sort of is the motivation for this book in many ways. What we see here is some measures of volatility of these key variables that should be related for advanced economies. These are advanced economies with floating exchange rates. And the top line shows the standard deviation of 4-quarter changes in their relative price levels. That sort of is a measure of inflation variability, and that has declined from 2.7 percentage points in the 70s to 0.8 in the past decade. Big decline. Countries have conquered inflation. It's credible, it's long-lasting. What about interest rates? Well, long-term interest rates are also quite volatile, but they have become less volatile and more similar across countries over time, as you can see. What about exchange rates? Well, exchange rates have not become less volatile over time. That's the amazing thing. And the surprising thing, I think, to people who had expected it. Not only are exchange rates a lot more volatile than you would expect given the other variables in the equation here, but there's no tendency for them to become less volatile. And I think that is the question. Why is that? So what went wrong? Well, there's two parts to this. One is that the purchasing power parity condition clearly doesn't hold in the short run, and there's lots of literature on that. Yeah. No?
Where you talk about the exchange rate volatility, talking about just the advanced economies against each other, or is this against the advanced economy and the developing economy?
Oh, yeah. So the question, in case you didn't hear, was are these volatility measures between the advanced economies and each other, or between the advanced economies and the whole world? And this is between the advanced economies and each other. Okay. This is not against the whole world, because obviously a number of countries didn't have these effects weigh on. So I'm just limiting it to advanced economies whose exchange rates were allowed to float against each other. The euro area is treated as one economy. I don't look at the intra-euro exchange rates. Anyway, it turns out that deviations approaching power parity, which are measured by what's called the real exchange rate, that's the amount to which broad price levels move against each other after correcting for exchange rates. Those things are not stable in the short run. But there's a lot of evidence, and the book does cite this, that those things are stable over time, that movements in the real exchange rate do tend to die out over time, and that the real exchange rates do return to PPP in the long run. That's a lot of evidence for that. But in the short run, they can deviate quite a lot. However, an interest rate parity doesn't hold really at any horizon, whether you're looking at 1-year interest rates or 10-year interest rates. There's just not any evidence that those are working. And there's a lot of literature, huge outpouring of literature for decades now on why this is, and it's quite a well-documented fact. So the error in interest rate parity has been called a risk premium by some people, and I'll use that terminology, because the size of that risk premium is related to risk. So when you reduce the riskiness of exchange rates by fixing them, you reduce the risk premium. But aside from that, we don't really understand the risk premium very well. As in other financial markets, there's been a lot of effort to try to explain these risk premiums, but my reading of it and the book's reading of it says that there really is a long way to go. We still don't understand them well. But one of the book's contributions is to show that risk premium movements are the major factor behind movements in exchange rates. In other words, if you look at the parts of the theory in PPP and IRP that explain exchange rates and try to say how much of exchange rates are explained by that, it's really quite small. Most of the movements we see in exchange rates year to year are due to these risk premiums. So just to dive a little deeper into that, because this is an important point, one of the key problems in measuring what the risk premium is that in these theories you need to have a measure of what exchange rates are going to be in the future in order to back out what the risk premium is. So one of the contributions of the book is to actually take advantage of the fact that over longer horizons we might have something more to say. And in particular, we can calculate risk premiums using the fact that real exchange rates return to purchasing power parity over a long run, say 10 years. We can use 10-year index bonds, and we can calculate what the risk premium then is over a 10-year horizon. So this chart does that. For the solid line is the real exchange rate between France and the United Kingdom, the risk premium in that exchange rate based on in 10-year index bond yields. And as you can see, it moves quite a bit over time. What then I have is the risk premium between France and Germany and the risk premium between France and Italy, which of course have fixed exchange rates. In this case, I just have used the assumption that all these three countries will stay in the euro area for 10 years. So then we know their exchange rate, what it will be in 10 years. And you can back out the risk premium just as a difference between 10-year bond yields in France, Germany, and Italy. And what you see is the dashed line is a slight excess of French bond yields over German bond yields, and the dotted line is French bond yields are a little lower than Italian bond yields. But for most of this period, you can see that they're much more stable. So in a fixed exchange rate, these risk premiums are much more stable than in a floating exchange rate. Now, in 2008, they widened out a little bit for France, Germany, and Italy with the financial crisis, and I didn't plot 2011, but if I had, you would have seen, especially the French-Italian risk premium would have gone way down, which does reflect, in fact, some risk in investors' mind that maybe the euro will break up, or maybe Italy might default on its bonds, at least some risk of that. So a fixed exchange rate, even a really firmly fixed exchange rate, is no guarantee against risk premiums, but it largely does have a big effect in reducing them. Okay, so now turning to other exchange rates more broadly, as I said, most of the movements in real exchange rates is driven by these risk premiums, and in fixed exchange rate systems, which are shown on the left, the real exchange rates are much less volatile than in floating exchange rate systems, which I'm showing on the right. So for example, the solid line on the left here is the real exchange rate between Germany and Finland, which are both in the euro area. So it basically is the ratio of prices movements in Finland and Germany. On the right, we have the real exchange rate between Germany and Sweden. Sweden being, in many ways, a country similar to Finland, but not in the euro area, and therefore having a floating exchange rate. As you can see, the real exchange rate between Germany and Sweden is much more volatile. And same for the other pairs in this example. That's just a common fact across all fixed versus floating systems. You just see more volatility in the real exchange rate, relative prices, when you have a floating exchange rate. Okay, so we've shown that exchange rates are volatile and in a way that we don't understand fully. There is a presumption that perhaps it's harmful. But what is the harm? Well, the harm that many people think volatile exchange rates might cause is that they make trade and investment across borders more risky. So if you are going to set up trade with another country with a floating exchange rate, you don't know in the future what you're going to be able to sell your goods for, or what your investment's going to return to you. And so that risk might discourage productive trade and investment across countries. It also, as real exchange rates swing back and forth, they might induce you to invest more resources in the tradable sector and then less resources in the tradable sector. And those shifts across sectors could be costly. These could reduce your long-run income and growth. On the other hand, if you allow the exchange rate to float, you can target your monetary policy at stabilizing other things. For example, stabilizing inflation, stabilizing employment or output. And it's possible that if you can stabilize them better that way, that risk is reduced for investors, and that may be a more important risk for investors. So it's possible that, in fact, you could be better off, even with this volatility, if you stabilize something else instead. Well, a lot of people have tried to study, which is right, and basically we can't tell. There's a lot of reasons why countries have different levels of income and different long-run growth rates, and this just doesn't seem to be an important factor among the other ones that are. It's not saying that there might not be some effect one way or another. It's just too hard to measure. It's not that big. It's not a major factor. So not much more can be said as yet on that issue. But what can be said is that although it's certainly possible that volatile exchange rates might be, in fact, a sign of bad policy and just everything's unstable, it is the case that for countries that have a stable monetary policy, that do focus policy on stabilizing inflation and output, allowing the exchange rate to float actually is associated with more stability in inflation and employment and output. And so these countries have succeeded, even with very large movements, even very large swings in exchange rates, haven't destabilized these countries. And so the book goes into all the evidence from other literature out there, as well as some new evidence the book develops to show that. Okay, and these gains are significant. I'll come back to them in a minute. Well, so one of the interesting things that the book documents is here's an example. We have some case studies in the book. Here's one example. Countries with very large movements in exchange rates, and yet they still had good economic outcomes. And that's sort of a motivation for what follows. But on the left here, we have the solid line is the rate of depreciation, four-quarter change of the UK exchange rate in the 1990s, as you can see. And in 1997, there was a huge appreciation of the pound. And on the right, the solid line shows the level. So the left is the rate of change over 4 quarters. The right is the level of the real exchange rate. And as you can see, that solid line took a sharp increase, about 20% in 1997. So this very large and persistent exchange rate movement, did it destabilize the UK economy? Well, no. In fact, this dashed line on the left is the inflation rate, which fluctuated relatively close to the central bank's target of about 2%, 2.5% at this time. And on the right, the dashed line is the level of unemployment in the UK, which actually fell steadily before and after this very large appreciation. So even though this, of course, appreciation did, at the margin, help to slow the UK economy down a bit, it made UK exporters less competitive, it wasn't a showstopper. It didn't throw the UK into recession. So how is that possible? And I guess that's what we want to answer next. How can this happen? How can there be these very large and persistent deviations from purchasing power parity in a globalized world? The UK is a relatively open economy, for example. Well, the book sets out 4 channels, and the bottom 3 have been the subject of a lot of research, and I've worked a lot on the third one there. And to be honest, I guess I came into this research thinking that the third one, price discrimination, was going to be the most important one, with the second one probably playing a supporting role. What I have found, actually, is, to my surprise, perhaps the first one is really the most important one to think about, and the book talks about that. In particular, a lot of economists have focused on the second one. So it is the case that a lot of goods are not traded around the world. And there are costs of trade, and there are taxes and tariffs applied on trade, these barriers that slow and prevent trade from happening. And of course, an important one is retail margins. For example, you might go to Walmart and buy a toaster, and that toaster might be made in China, but a lot of the price you pay for that toaster goes to paying the salaries of people who work at Walmart and the rent on their stores and their profit. And all that is fixed in dollars. And so if the dollar moves against the Chinese renminbi, that will not change. And so the US price level may move relative to the Chinese price level when the exchange rate changes. That could explain why real exchange rates can move. A lot of work has gone into this, and the fact that that sort of element of a lot of what we buy is just not tradable could be important. So the question is, how important is it? Well, one test is to say, well, let's look at real exchange rates, relative prices, for just those goods that are purely tradable, that don't have any non-tradables, don't have high barriers or tariffs, don't have taxes, and that don't have any of these retail margins or distributions included in them. Well, one such thing would be if you take a producer price for manufacturers, which are priced at the factory gate, they don't have any retail margin, they don't have taxes included, and they're highly tradable. Maybe those things should have less obvious exchange rate swings, real exchange rate swings. Well, do they? Well, what I show here, and this is true for many other countries too, is the real exchange rate between the US and Japan based on producer prices in manufacturing, that's automobiles and computers, etc. The solid line is that real exchange rate. This is a highly tradable good. Between the US and Japan, barriers are very low, transportation costs are relatively low, there's no taxes implied, there's no retail margins here, nothing non-tradable in this basket. The dashed line is the real exchange rate between the same two countries, including everything, all consumer goods, including services that aren't tradable, housing, retailing, etc. And that should look very different. Well, it doesn't. So this really calls into question, is tradability, are these barriers to trade, retail margins, et cetera, really that important? Are they essential to this story? And I guess the answer is, well, they may be playing a role, but they don't seem to be essential. So what the book does, and I will not have time to go into this in much detail, but is builds a little model of a small open economy that has many of these features embedded in it, and that can replicate some of the movements that we see in economies when risk premiums move. And then we can take these features out one at a time and say, well, is this one important? Is that one important? Which one's important? So that's sort of what the book does. Unfortunately, I don't have time to go into as much detail as I would like, but here's a drawing of sort of what we found. Basically, what we've done is we've taken a small open economy, we've hit it with a persistent but not permanent risk premium shock, and caused it to have a real exchange rate depreciation, about 4%, which gradually unwinds. Okay. Then the various dotted and dashed lines are alternative simulations in which I take out one at a time, or two at a time in one case, some of these features I talked about. And what you find is that, in fact, price stickiness or flexible prices makes no difference. Full pass-through, if exporters charge the same price abroad as at home, that makes a small difference. If all goods were tradable, in the base case, about half of goods produced are not tradable at all and half are tradable. If they were all tradable, it makes a little difference, not much. What makes the difference? Well, what makes a difference is if the goods that are tradable are viewed as perfectly substitutable across countries, so that you're perfectly happy whether you have a Chevrolet or a Volkswagen at the same price, that makes a difference. Then suddenly you can't have these swings as much in real exchange rates. And interestingly, there is some interaction. In that's that line in the middle there. And there is a role for non-tradables, because if you then say, well, let's combine that perfect substitutability of tradables with all goods being tradable, so everything can be exported or imported, and they're all perfect substitutes, then you get the big heavy dashed line at the top. Basically, you can't have deviations in relative prices across countries in that world. Okay, so the key thing is that consumers just don't see goods produced in other countries as very close substitutes. They're somewhat substitutable, but they're not very close substitutes. We used substitution trade elasticity of 1.5, which is a little high already. A lower number would strengthen this result, but even a little higher number wouldn't eliminate it. Okay, so I'm going to skip this slide. That's about the effects on output. Basically, monetary policy, in this world, monetary policy is able to stabilize output and inflation despite these large risk premium shocks. But again, if goods were perfect substitutes, monetary policy would have a harder time doing that. Now, what many studies have found, basically, that the key to economic stability in the face of exchange rate volatility is sound monetary policy that's got its eye on the ball, stabilizing inflation and employment or output. So we review those studies. We also have 11 case studies in the book of specific examples of very large exchange rate pressures that central banks responded to either effectively or not, and what happened. And what you find is that when central banks focused too much on the exchange rate pressures, they ended up destabilizing their economies. I'm not going to have time to go into those case studies, but we also will present, so this, for example, these are a couple of case studies for Australia and New Zealand in the Asian crisis, but I won't have time to go into them. But what I do want to talk about is some summary statistics, because case studies you could always say, well, you pick the one example that worked, although I have 11 of them. But anyway, what can you say more broadly? So for all the advanced economies, the top three rows of the table summarize what we find. So the advanced economies that have a fixed exchange rate are the countries in the euro area, original members of the euro area, 11 countries, plus Denmark and Greece, which have had fixed exchange rates to the euro ever since 2000. Of course, Greece joined in 2001. So they've had fixed exchange rates for the past 11 years. The criteria I'm going to judge countries on in terms of stability are going to be the volatility or standard deviation of their nominal GDP growth, the first column, which is really a combination of inflation and real growth. Second column is just CPI inflation. And the third column is the output gap, deviation of output from potential according to the IMF. And what you see in the first column is that for those economies with fixed exchange rate in the euro area, nominal GDP had a standard deviation of about 3.5%. But the euro area as a whole, taken as a whole, as the second line, standard deviation of only 2.5%. So quite a bit more stable. And this is the classic, conundrum of fixed exchange rates. What stabilizes the region as a whole is not necessarily what stabilizes each individual member. The members had worse outcomes than the average. And for other advanced economies, all the other advanced economies with floating exchange rates, the standard deviation of their nominal GDP growth was about 2.5, same as the euro area. So they had better outcomes in that stability sense. And the same holds true for inflation on its own or for the output gap on its own. Turning away from the advanced economies to the transition economies of Eastern Europe, we see there are 4 countries that have continuously pegged to the euro through this period and 2 countries that were continuously floating. And the floating countries did quite a bit better over this period. Now, we also looked at some developing economies. These are the advanced economies. And what we found is, and I'm not going to have time to show you, that the developing economies that have had inflation targeting monetary regimes have done very well in the past 10 years, and much better than their previous history. And so there's another case of floating exchange rates, sound monetary policy, good outcomes. But those countries, even those developing countries, are moderately large countries. What about the smallest countries, really tiny countries? So what we did is we said, look at 144 countries that have data. Let's take 70 of them that have GDPs in 2009 of less than $50 billion, so the smallest countries in the world. And I don't have information on how good their monetary policy regimes are. I'm sure a lot of them have really bad policy regimes. Of those 70 small countries, small and poor countries, I might add, 8 had continuously a floating exchange rate throughout this period, and 62 either had fixed exchange rate of some type or moved in and out of fixed and floating. What you see is that floating exchange rates are associated, and this is a common finding in other literature from before, that a little bit more inflation in a floating exchange rate regime, but not a lot, maybe 2 percentage points, a little bit more variable, but moderately. But interestingly, quite a lot more growth, faster growth in these countries, and less volatility of growth. Now, this is a small sample, eight countries, so it's not the most definitive thing, but it just shows that even in tiny countries, some of these countries have only 2-3 million people, and they're very poor. GDP per capita, less than $1,000 per person, and yet they still manage to have reasonably good outcomes. Says that perhaps floating exchange rates are even possible where you might not have thought so. Let me turn to the final point before wrapping up, and that is another issue associated with developing economies, and that's a very important issue, I think, today. And that is that in countries where capital is not so mobile, it's possible that central banks may be able to influence their exchange rates using foreign exchange intervention, reserve accumulation, independently of how they set interest rates. And they might actually target interest rates at inflation and output while still retaining some ability to influence their exchange rates separately. That's a lot harder to do when capital is mobile, but it's somewhat easier in some of the developing economies. And indeed, since 2000, the developing economies as a group have used massive foreign exchange intervention to hold down their currencies and to generate current account surpluses. And for example, these data come from the IMF. What you see in the solid line here is the net official outflows of capital from the developing economies as a group. That is primarily foreign exchange intervention, reserve accumulation, but it also includes official borrowing and lending. That, if you went farther back in time, it would be close to zero throughout and all the way until about 2000, and then it just exploded. Now, it reached almost 1.3 trillion in 2007 before crashing during the global financial crisis, but it's now on its rebound. And the IMF projects, that last number there is IMF projection for this year, about $1 trillion of reserve accumulation this year. And that does not include purchases of foreign assets by sovereign wealth funds in the same countries, which is another form of official flow that's not included in this number, so it understates the issue. That $1 trillion this year is 1.5% of world GDP, and most of it's going to Europe and the United States, where it's about 3% of European and US GDP, which is a large magnitude as a net saving flow when you consider that net saving is only usually on the order of 2 or 3%. So this global saving glut is, I think, having a material effect on the US and European recoveries right now. It's not clear how much longer this can continue. As I said, there is some ability to sterilize the effects of this on inflation in these countries, but it's not perfect, and inflation is getting higher in some of these countries. Also, the fiscal costs of managing this are getting higher because they're borrowing at much higher rates domestically than they're earning on their assets. So it's not clear how much longer this can go on. But the book sort of has a short section on, do we need rules of the road? And in particular, perhaps there should be rules that would prevent massive reserve accumulation beyond a certain point when countries have sustained and persistent current account surpluses. If these countries really do want to peg their exchange rate, perhaps they need to do it through monetary policy, interest rates, and basically allow the inflation to happen if that's what they want. It does seem to be a bit of a beggar thy neighbor policy in the sense that it's taking demand from other countries to support growth in these countries. So I think we need to think about rules of the road to make this sustainable. Perhaps a more symmetrical currency system would help with this expanded SDR. This is not in the book, but it's a proposal I have on the Peterson website recently. Also, the book talks about a new version of John Williamson's reference rates. Many of you may be familiar with the target zone proposal he had from years ago, but in 2007 he released a new book that modified the old target zone proposal, and I actually found it actually a huge improvement, and I don't have time to go into the details, but if you keep in mind that the new proposal doesn't involve any particular line in the sand, any particular level exchange rate that will be defended, and it allows monetary policy to keep its focus on inflation output, as this book recommends, then I find it consistent with my book. Perhaps central banks, even in advanced economies, could use foreign exchange intervention a little bit, sensibly, to sort of stabilize some of the wilder excesses of exchange rates. It's not clear how much would be gained from this, but on the other hand, the cost seems pretty low. I don't have time to go further. And let me conclude with the book's conclusions. Basically, as we've said, flexible exchange rates are the best set up for most countries, again, assuming that you can have a sound monetary policy that's focused on stabilizing inflation and output. But a currency union may be appropriate for a country that really desires very close economic and political integration with its neighbors. However, as we've seen, this year in the euro area debt crisis, it can be very difficult to get all the policies in place that you need to support that. So it's not an undertaking. It's not something to be undertaken lightly. The other case might be a fixed exchange rate would be the best feasible outcome if a country lacks the institutional ability to conduct a sound monetary policy. But again, as we saw, a number of very small and poor countries actually had pretty good outcomes with a floating exchange rate in the past 10 years. So I wouldn't rule out flexible exchange rates even in that case. Anyway, thank you very much.